You know, the U.S. steel market is sending a really clear signal as we head towards the end of 2025. Nucor just announced its seventh price hike in a row, and it's solidifying a rally that, honestly, defies a lot of conventional market logic. So today, we're going to break down exactly what's driving this trend and what it all means for your business.
Okay, so here's the game plan. We're going to start with the big news, the price hike itself. Then we'll get into the paradox of what's happening with supply. After that, we'll look at how things differ region by region, unpack the cost and psychology behind this whole rally, and finally look at what's on the horizon for early 2026.
All right, let's start with the catalyst for all of this, Nucor's latest price increase. Now, this isn't just some minor tweak. This is the move that really confirms a bullish trend that's been building up for weeks now.
So as of the week of December 8th, 2025, the new consumer spot price for hot-rolled coil is $930 per short ton. And make no mistake, this number, it's the new benchmark that everyone in the market is watching.
But what's really crucial here is the consistency. This is the seventh week in a row that Nucor has pushed prices up. That's not a blip. That is a sustained market rally, and it signals a very, very confident strategy coming from the biggest producer in the country.
Now this is where things get really interesting, because this series of price hikes creates a fascinating market paradox. See, normally you'd expect rising prices to be fueled by strong demand and booming production, but in this case, well, the numbers are telling a completely different story.
I mean, just keep a look at the production figures. Domestic steel output actually went down, dropping from 1.761 million tons to 1.736 million. That's a pretty noticeable dip, especially at a time when prices are climbing this aggressively.
And we see the same story with the capacity utilization rate, which is a key measure of the industry's health. It fell to 75.8%. That's actually the lowest it's been since the beginning of October, which tells us mills are deliberately running less of their available capacity.
So this brings us to the million-dollar question, right? How on earth can the industry support 7 straight price hikes while it's actively making less steel? It seems totally backward, but there is a very clear strategy at play here. And the answer, in 2 words, is supply discipline. U.S. mills are making a very calculated decision. Instead of chasing volume and flooding the market with steel, they're carefully managing their output. By keeping supply tight, they stop inventory from building up and give their price increases the backing they need to stick. It's clear that right now price integrity is the top priority, way more so than sheer production volume.
Next up, let's look at the regional picture. Because this new $930 price tag, well, it isn't a one-size-fits-all number across the country, and the differences are pretty telling.
Here's a really critical distinction. While most of Nucor's mills are now at that $930 mark, California Steel Industries, or CSI, is priced at $980 a ton. That $50 premium is a direct reflection of the unique logistics and the import market dynamics you see on the West Coast.
And that drop in production we talked about, it wasn't spread out evenly, not at all. 4 out of the 5 major steel-producing regions actually saw their output fall, but the southern region saw the biggest drop in tonnage. Now, for buyers sourcing from those mills, this tightening could easily mean you're facing longer lead times come January.
So, what's really fueling this rally? Well, it really boils down to a combination of 2 powerful forces that are working together: hard costs and good old-fashioned market psychology.
First off, there's a definite cost push happening. The basic ingredients for making steel are just getting more expensive. We're seeing both iron ore and coking coal climb to 1-year highs. So with those input costs on the rise, the mills are simply passing those increases along to protect their margins.
But the second driver is pure psychology. You see, 1 price hike, that might get ignored. 2 could be a test. But 7 price increases in a row, that sends a powerful message to the entire market. It creates a classic fear of missing out scenario.
And what this does is create a self-fulfilling prophecy. All the buyers who are sitting on the sidelines waiting for the market to hit rock bottom now realize they've missed their chance. They're forced to jump in and book tons now, which of course validates the mill's asking price and just adds more fuel to the fire for the next increase.
So, let's tie all this together. What does this all actually mean for buyers as we start looking ahead to the first quarter of 2026?
Look, the message coming from the mills could not be clearer. Their focus is on price, not volume. The whole period of aggressive destocking and hunting for those rock-bottom deals, that's over.
For buyers, that means the window to try and negotiate any big discounts is closing, and it's closing fast.
At the end of the day, what these 7 hikes have done is completely reset expectations. The price floor for the first quarter of 2026 is being set right now, and believe me, it is significantly higher than what most analysts were predicting just a couple of months ago.
So we'll leave you with this final question to think about. We're in a really unique spot here. Low production rates, but high and still rising prices. So, if demand comes roaring back after the holidays faster than expected, is your inventory strategy ready for a potential supply squeeze while the mills struggle to ramp back up? It's a critical question for everyone in this industry to be asking as we head into the new year.